College is expensive, y'all. Funding college probably has been one of the I would say my biggest financial anxieties, if I can use anxiety. It's probably a little too strong of a word, but it's probably as a parent, it's probably one of the costs that I have dreaded the most. I have thought about the most. So I have asked back again my friend John Hupalo from My College Corner. I was thinking about this morning. John is the most, has had the most appearances of any guest on this podcast, Stuff About Money They Didn't Teach You in School podcast. I'm Erik Garcia. I'm going to be your host for today. And this is part two from our conversation from last episode where we talked about the FAFSA and what is the FAFSA and all the anxieties around the FAFSA. And like I said before, these are very selfish episodes because I am going through the college process with my kids. I have completed the FAFSA. We have applied for federal loans. But as a parent, well, first of all, John, welcome back again to the show.
This is awesome, Eric. I'm really honored to know that I'm your most frequent guest. I love talking to you, but I'm not surprised for one reason because this is a topic that everybody, like, even hosts of like money podcasts get nervous about talking about college. So thanks for having me back. I love to talk to you and I look forward to this conversation today.
Yeah, one day we'll never talk again. Once my kids get through college, our friendship, our relationship will end.
Over.
This is one of convenience. No,
Yeah.
uh, no,
I know my
actually,
role, Eric. It's all good, however it
no,
rolls.
actually, I can honestly say that we have become friends through all of our conversations on college and have had very wide and diverse conversations about things other than college. So I appreciate your professional insight into college planning, but then also your friendship. But John, I have a lot of clients. I work with a lot of clients, probably in that similar to me, right? I'm mid 40s. I've got a business and I've got a family. And most of my clients are starting to think about college. They have younger kids, or their kids are becoming close to college age, and college is becoming really real. And if there's one thing that I would say, this is a generalization, but I think it's fair to say most parents want the best for their kids. They want the best for they want their kids to have opportunities that they might not have had as parents. I see that time and time again, and you're nodding, so I'm imagining that's
No,
been your
no,
experience,
no question. No question about
right?
that.
And I'm the son of immigrants, and it's probably even more pervasive in the immigrant community where they will do whatever it takes to put their kids through college. And I was thinking about this. I'll often have conversations with clients and they want to start saving for college. And they're woefully underfunded for retirement.
Right.
And there's this tension of retirement or college. College seems more real. It's more present. It is the next big thing. So their attention is on college and they neglect retirement. So
Right.
there's this kind of tug of war of what do I do with my money?
Yeah, and we talked about it last time. It's the emotional thing, right? Because the rational answer to that is, and you said it last time, I agreed 100%. You can borrow for college, you can't borrow for retirement,
Yeah.
right? And so that idea of putting your nest egg away, it's overused all the time, but it's the same thing. Here comes I'm on an airplane, and here comes the mask. Like, what do I do first? I put it on my kid or myself, right? You want to take
Yeah.
care of yourself so you can take care of your kid. And it's the same thing, right? You use that analogy all the time. So yeah, it's an emotional thing, and some college, the thing about college is, though it's near term, if you have a 7-year-old, it's not tomorrow, right?
Yeah.
And so that becomes the issue. And I'm glad that we can have this conversation because I think trying to wring the emotion out of this whole thing is more than half the battle
Yeah.
sometimes.
And so what we're going to talk specifically about today are different loans that are available to pay for college. Now, let me say a couple of things as we talk about borrowing money. Debt is often demonized in our culture, and rightfully so. I mean, debt is crushing. Debt
Mhm.
wrecks relationships, debt wrecks wealth. It is crushing. However, we do know that there is a positive economic return for getting a college degree. And I like to talk about debt in terms of good debt and bad debt. I say,
Mhm.
well, let me say bad debt and acceptable debt.
Can I
And
say responsible debt?
yeah, there we go. Responsible debt.
Yeah, because I think that's like the difference almost in every one of those situations. And this is not a judgment. It's just an observation after a lot of time that the borrowers, whether credit card borrowers or student loan borrowers, the one who's getting into trouble are the ones who have gone that sort of extra, they did a little more than they probably know they should have. Right.
Yeah.
And that becomes the issue. So I take it back and for me personally, as a personal responsibility thing, borrow responsibly. And we can talk a lot about what that means and some guidelines as we go through this.
Yeah.
But responsible borrowing, I think, is really a great way to think
I like
about it.
that. Responsible debt. And this is I kind of think of it through this matrix is what is the return on my investment? It's the same thing with if I make an investment decision, what am I going to get back? If I'm
Yep.
borrowing money, my cost is interest. What is the return that I'm going to get? And we know statistically, not guaranteed, this is the risk of borrowing for college. This is the risk for paying for a degree. But we know that there's a positive economic return on that degree, that most kids earn more over their lifetime because of that degree. So going to college, paying for a degree, and incurring possibly some debt is not a bad investment so long as it's, to use your word, responsible.
Yep. I agree.
So,
And
no, go ahead. Go ahead.
so what I think you also have like put a nuance in play here that we have to like actually sort out right at the very top. Because we talked about parents wanting to take care of their kids and then borrowing and then get a return on the investment. But the question, Eric, is who's borrowing, right? And who's getting the return on the investment. So at the
That's
very
good. Yeah.
right at the very top of the funnel, at the very top of the funnel, and this is like the key question to ask right at the start, who is the borrower? Because when you're borrowing with I'll say this, there's a misnomer. We lump student loans together for student loans, but there are parent loans for college, right? There are student loans for college, but we talk about students. So we get this, it gets really fuzzy sometimes, right? We're borrowing. So let's start right at the top because we talk about like which loans are responsible and which ones are not and all the rest of it. The very first question is who is signing that note and who is ultimately responsible for making that payment,
Yeah.
right? And we can parse that out as we're going forward. But I think for parents particularly, and this goes to the question about saving for retirement or borrowing for college, who's borrowing? And if I'm a parent, and I did this by the way, I co-signed a loan. We'll talk about this in a minute with my daughters, but I had some responsibility for that, right? And so knowing how much I have responsibility for and how much I might be able to shed going down the line once my student becomes now a worker, we,
Mhm.
we need to talk about that. But at the very top of the funnel, who's borrowing the money? Who's making that responsible decision?
So let's start with the student is borrowing money with the most basic loan available, which are the federal loans, right?
Correct.
And
Yep.
the only way, and we talked about this at length last podcast, the only way your student will qualify for federal loans, no matter how much money you make, if you make $0 or if you make $10 million a year, the only way they can qualify is if they complete a FAFSA.
That is correct.
So FAFSA is your ticket to federal loans, even if you're not going to get federal aid.
That's correct.
Okay.
And the other part of that is you said $0 or 10 million. Every single student who goes to college, no matter what parents make or have, is eligible for a federal student loan.
Okay.
There's no income criteria on it at all.
In the federal loan space, there's typically I mean, there's the federal loans, but they're classified as subsidized and unsubsidized federal loans. So
Yeah,
maybe we're getting ahead of ourselves, but let's talk really quick about subsidized versus unsubsidized, and then we can talk
yeah,
about federal loans, how they work, and so on and so forth.
yeah, cool. So let's go back to what I was talking about at the top of the funnel, and let's go to the student side because there are also federal loan programs for parents. But let's
Okay.
stay with the students. Okay,
Okay.
so we're with the student, and for this, let's talk about an undergraduate student, a first-time borrower, right? A
Okay.
freshman going into freshman year, because it simplifies everything.
Okay.
So the question there is, what are they eligible for? So you go through that FAFSA form, and it spits out an eligibility, and what the school will receive is from the federal government says this student is eligible for a subsidized and or an unsubsidized loan. And just what it means, basically, a subsidized loan means that the student is not responsible for paying the interest while they are in school and up to 6 months after they separate. And there's a lot of detail here, so I'm going to try to say at a pretty high level, but the separate basically means graduate or leave, okay, at a high level. So the difference again, subsidized loan, you're not responsible for those interest payments on that loan while you're in school. For an unsubsidized loan, the student is responsible. And what that means is they have an option. They can either pay the interest, just the interest while they're in school, or they can let that amount of interest that's accruing add on. So accumulate or capitalize for us financial guys, right? Capitalize the interest. And I'll make this point. These numbers are not right, but it's directionally accurate. If I borrow $1,000 and I don't pay the interest in school, when I graduate, I'm going to have a borrowed amount that will be something greater, maybe 1,100 or whatever that total amount of accumulated capitalized interest is. So my advice to everyone, parents particularly, if your students in school, they don't have a job, if I can, I would pay that interest for the student while they're in school. So this way, if they borrow $1,000, when they graduate, they have $1,000, and then they start paying interest on 1,000 rather than on 1,100 in my example.
Okay.
So
Let's go back to the subsidized. So an
yeah,
unsubsidized, the interest will accrue.
correct.
Basically add to the principal of the loan.
Right.
In a subsidized, the student does not need to pay, but doesn't accrue at all. So basically, does the government pay the interest? So if I borrow let's say I have a subsidized loan,
Yep.
I borrow $1,000.
Yep.
When I graduate, what's happened to all that interest?
Yeah, so this is great. The other very high level thing is we want to know who the borrower is, then we want to know who the lender is, right? So in this example, the lender is the federal government, which means it goes to the technically the federal student aid at the Department of Education, and the Department of Education is the lender, and it's the government. So you tell me what happens with the government, right? I don't think they're actually
Yeah.
making transfer payments, but the bottom line is the student doesn't have to worry about making that payment, and it's not going to be added on when they
So,
graduate.
so in general, interest doesn't start accruing until they graduate or they
6 months
separate
after
6 months,
yeah,
whatever
yeah,
that
yeah, yeah,
definition of
yeah,
separation is. Okay,
yeah, exactly.
very cool. So that is the only difference between subsidized and unsubsidized is the way interest is dealt with during school. Now,
Yeah,
break down.
before we go, before
Oh,
let
go
me
ahead.
just make this point, Eric. Sorry, again, more detail, but really important detail. And that is a student can be eligible for both a subsidized and an unsubsidized loan, and there are maximums. And by the way, if anyone's interested, go to studentaid.gov. Studentaid.gov is a really good government website where all of this is laid out in plain English. So, I'll try not to get too far into the weeds, but for instance, this is a very technical point. A freshman borrower can take up to $5,500 from the federal government, 5,500. But some amount of that, and I think it's 3,500 if I remember correctly, maybe not, but part of that can be subsidized and part of that can be unsubsidized. And where that comes from is what I started at the beginning. The FAFSA form, college gets a notice from the government and says you can give this student whatever it is, $2,500 of subsidized loan and 3,500 of whatever, however the math works out. But at
Mhm.
the end of the day, the government tells the school how much eligibility the student has for a subsidized or unsubsidized loan.
And this is why when most people graduate, they have like 6 or 7 different like loan numbers, if you will, right? But
Yep,
typically it's
yep.
one payment. One payment is dispersed across all the different iterations of
So,
borrowing.
oh boy, you threw softball and you didn't even mean to. So you're a great pitcher. So here's what I mean by that. So we talked about what we can borrow. Then how do I document that? There's something called a master promissory note.
Okay.
So a student will get a master promissory note once they have been approved and they matriculate in the school, and the school says, okay, we're going to go to the government and we're going to get the $5,500 from them on your behalf. But you sign electronically this master promissory note, and then that note is actually used in future years. So they just add on, add on, add on. So you're not re-signing every year. Now, some people think that's a really great thing because it's simple. Others don't love it so much because all of a sudden I'm taking 5,500 freshman year, 6,500 sophomore year, 7,500 junior and senior year, but maybe I signed one time and now all of a sudden I can have up to $30,000 of debt. And that's how come some kids will graduate and say, well, how did I get all these loans? I signed one time in the beginning for 5,500. So again, the master promissory note is the legal obligation that the student has to repay that debt to the government.
Okay. Maybe you're the good pitcher or bad pitcher, right? So you don't, I mean, you don't want to lob pitches, right? Uh, so you're signing one master promissory note,
Right.
but the iterations of that borrowing every year, right?
Mhm.
Don't automatically come, right? There's some type of election or some type of something that you do to say, yeah, yeah, I want that money. You're
Right,
making
right.
a decision, a manual decision to receive the next round of funding, correct?
Yeah, so what's going to happen is you have to file that FAFSA form each year, the student for the next academic year, right? So you're filing right through junior year in college for senior year. And when you do that, then the financial aid office sends you the note back and say, okay, this year you're eligible for this amount. And you say, okay, and then you get your money, and
Okay.
again, in short form.
Now, every year you mentioned this. I just want to signpost this right here. There
Mhm.
is a maximum that you can borrow per year in college,
Correct.
freshman, sophomore, junior, senior, and
Right.
it's an increasing amount. So say those numbers.
Except, yeah, so 5,500 for freshmen, 6,500 for sophomores, and then juniors and seniors are at 7,500 each.
And if
So
we
it
do that
plateaus.
math, we're right at what's the amount? Right around
Uh,
30,000.
yeah, it's just a little, yeah, that's right. There's also like a maximum borrowing amount that you can have, which is somewhere right around 30 or $32,000
Okay.
total under the federal program.
And that just happens to be the average loan amount per I guess American student is right around $32,000.
Yeah, somewhere in there. There's data from 32 to 35 or so, but yes, about that amount. And this is a good time to say this. And people say, well, is that a lot? Is that a little? Am I going to get a return on that investment? The thumbnail that people accept the axiom is that if a student's starting salary out of school is greater than or equal to the amount they borrowed, that should be a responsible amount of debt for that student.
That's good. And I got that from you several years ago, and that's what I tell people. Like if you expect to graduate as an engineer and make 80,000 a year, then it's reasonably acceptable to graduate with $80,000 of debt, right?
Mhm.
Obviously the least amount of debt, the better. Okay, so that begs the question. If
Yeah,
I can only borrow 30,000 from the federal government,
yeah,
and if we need to talk more about federal student loans, we can talk about. We'll get to the parent borrowing in a second, okay?
yeah.
If I can only borrow as a student 30,000 from the government, and I'm going to need a lot more than that, where do I go next?
Yeah, so in the funnel, the way I like to think of this is there are a bunch of arrows in the quiver, right, to pay the college bill. And so when a family gets that number and says, okay, you have to come up with, let's just make up the number. So you have to come up with $20,000,
Yeah.
okay? And this is after the government's given you 5,500 for the year. So then and also after you've gotten your financial aid award letter, right? So your financial aid award letter says, okay, the school's going to give you this, and the government will allow you to borrow that, and you still have to come up with $20,000. Like, how do you do that?
Hmm.
So private scholarships is one place to do that. Another piece, Eric, that I like a lot, I think it's a hidden gem of college financing, are payment plans, tuition payment plans. And so generally, every school has a third party that says to the incoming students, hey, by the way, if you pay us a fee, and the fee is usually somewhere around 50 or $75 or whatever it is for the school, we'll advance some of that money to the college and you pay us every month. And so, like, as a parent, what I liked about that is, little Sally goes off to college and she's not eating, she's not taking gas out of my car. My disposable income is actually a little bit bigger now. So I might be able to take some of that disposable income and use one of these payment plans, maybe $100 a month or whatever it might be, to actually reduce the amount of student borrowing that would be necessary. Again, it's one of these ways that parents can help the student. The obligation there is, I'm just going to use this disposable income, usually over like a 1 semester or 2 semesters, so 5 or 10 month period. I'll pay this company whatever I agree to pay. And for that, they're going to give the school the money up front. So
It sounds like a lot like I know down in New Orleans, it might be the same up in New York. We've got a lot of our students down here go to private schools, and tuition might be $10,000. So a lot of the local banks will say, "Hey, look, we'll front the tuition, and you're going to pay us $800 a month for the balance of the year, and
Yep.
we're good." Is that kind of the same
Yeah.
thing? Almost seems like a really
Yeah.
short-term type of loan deal. Now,
Yeah.
are those arrangements typically offered, or do students have to go seek them? Like, do they go to the schools directly and ask, "Hey, do you have a third party?"
Yeah, you can ask that question, but almost always it's in the tuition bill. It's like here you go, and like here's an opportunity to pay that way. So, I mean, even if you reduce the student loan amount by $1,000, right? It's $1,000 less the student has to take and pay interest on. So that's one of those little things where over time that could add up and really increase the ROI for the student pretty significantly. So I like those.
Good.
So if
So
they come up,
let's
check it
assume,
out.
yeah, let's assume mom and dad can't cash flow anything.
Yeah,
So
they can't cash
we
flow
have twenty
anything. And
thousand dollars. We've exhausted the federal student loan.
yep,
We got some financial aid from the school. Maybe there's
yep.
some work study built into there, but I still have $20,000.
Yeah. The way you close that hole is through savings. So we talked about 529 college
Yeah.
savings plans before, right? Maybe you have some of that. Maybe in our example, to make this a little easier, let's just say that the parent has 5,000 in savings they can put
Okay.
toward this. So I got 15,000 to close. Maybe the student, you talk about work study on the financial aid award letter. Again, it says eligibility for
Yeah.
federal student aid. It's not a guarantee. It's just a job. The student might be able to get a better job, higher paying job, something in their field elsewhere. The one thing about, again, part-time jobs for students is they're students, right? So you don't really want them working 40 hours a week while they're going to school full time. So, is that a 10-hour a week job or whatever it is? But let's just say like during the course of the year, they can knock off like another 5,000 just to make it easy. So now I've got 10,000 to go, right?
Yeah.
And now I look around and say, okay, now is nut cutting time because it's really hard. The options there, other than winning the lottery, and I'm not saying people should go play the lottery and hope that's how they're going to fund
We're
their
talking about
college
response.
education.
We're talking about being responsible
Yeah,
with money here,
responsible. So
John.
we're not doing that. The other thing we're not doing, Eric, is we're not putting it on our credit card, right?
Yeah.
That is like a disaster. I tell parents, parents of means who have good lines, and they say, "Well, I'm going to put it on there because I'm going to get the frequent flyer miles or the cash." That's great as long as you pay it the next month,
Yeah.
right? So that's not. Don't go and borrow money for college at 25%, right? That makes no sense. So I think credit card should be off the list. Also, I think off the list should be borrowing against your 401k for the
Oh,
reason that we talked about earlier.
thank
You
you.
know,
Yeah.
I'm not a proponent,
Yeah.
so don't do that. Retirement funds are for retirement, college
Yeah.
is for college. But I've got 10,000 to do. Like, what do I do?
Mhm.
And so now we're at that point we're talking about emotionally what happens. Do I want, as the parent, go borrow that $10,000, which I might be able to do? Or do I say to the student, we can't afford that school? Because remember, it's 10,000 for the first year, Eric.
Yeah.
So it's 40,000 or
Yeah.
50,000 once everything comes to pass, right? So
Mhm.
I'm not borrowing 10, I'm borrowing 40 or 50.
And that's on top of what we're already borrowing federally. So we borrow 30,000 from the federal government, and then if I have to go borrow another 40,000 privately, I'm assuming that's our kind of our next route,
Yeah.
then that's we're at
Well,
70,000 of borrowing.
Well, again, let's go to the top of the funnel. So the student's taking 30, and now I, the parent, is saying, am I going to
Yeah.
supplement them? Right. Let's just do two other things about the federal loan program that I want everybody to
Hmm.
know, and I don't want to gloss over. One is that it's a fixed rate loan, and that loan rate is set on July 1st every year for the next academic year. So July 1, 2024 through June 30, 2025. That loan rate is in effect. This year, it happens to be 6.53%. I won't give you the gory details of how they get there, but there's a formula. So this year, it's 6.53 for undergraduate students. For graduate students, a little over 8%. But again, that's a fixed rate loan. So I like that personally because now I can budget. I know what the monthly payment's going to be. I know if it's subsidized or unsubsidized. That's great. There's also an origination fee,
So
Eric, which
before we get to the origination fee on that
yeah,
rate,
yes.
that's just on new money. That's not retroactive on existing loans, correct?
Yeah, so that's a great point. So it's all loans made in that date, July 1 through June 30. So if the freshman, I'm going to take a loan for next year at 6.53, but on July 1 next year for my sophomore year, there's going to be a new loan rate.
Okay.
And I can't negotiate that. It's whatever it is, it is. Okay. And that will change probably each of the years going forward. So, but it's a fixed rate and it's from the federal government. And I think for undergraduate students, it's by far the best deal in town and probably no other deal in town. Because who lends money to a
Yeah.
19-year-old with no job and no job prospects, right? So you
Yeah.
take that. The other thing, by the way, and we've seen this over time, we could talk about this like in a whole nother show another time, but the repayment, they have income-based repayments now so that when kids get out of school, if they're not making what they thought or whatever, there are ways to sort of manage that cash flow a little bit. And so again, for all the reasons, the federal loan is the place for a student borrower, no
And I'm going to say
question.
it again. I'm going to say it again. I'm going to emphasize it. For my high income listeners and my high income clients, still complete a FAFSA. You have to complete the FAFSA to have access to this loan.
Yes.
Okay.
And in Louisiana and other places, it's required to graduate, right? Unless there's an
Yeah.
opt-out. So, but yes, 100% do the FAFSA form so the students can be eligible for that. So we still have 10,000 to go, Eric.
Yeah.
And we're sitting there saying, okay, what do I want to do? So, a higher income, higher asset family will say, okay, we can go and borrow. I'm willing to do that. So I have, as a parent, really two options to borrow for my student. One of them is under the federal program
Yeah.
called the PLUS loan, parent loan for undergraduate student. I'm going to say at the top, I do not like this loan. I think it's usurious. There's a lot to it. I'll give you the facts. Your clients can decide whether or not they think this is a good idea for them or not. I've told you what I think. So the fact is, it is a parent loan. There's no ability for a parent to somehow transfer that loan to the student after they graduate. A lot of people say, oh, it's okay when they graduate, they're going to take it. No, they may make the payment to you, but you are legally responsible for that loan once you sign it, and there's no way to transfer it. So that's one. Second is that the government will says that you are eligible to borrow up to the full cost of attendance, uh, and there are no real credit tests with this. So the credit test, and again, go at the studentaid.gov, but the credit test is like, no 90-day delinquencies, basically. So they're not testing your income. They're just saying, have you been delinquent on any other loan? And we'll give you up to the full cost of attendance. And this loan, this year, the loan rate is 9.08%, and the origination fee is 4.23%.
This, okay. You talk about responsible borrowing. This is irresponsible lending.
I say if the federal government was not the lender and it was, John's bank lender, and I was the number one lender in the entire world, the Consumer Finance Protection Bureau would not let me make this
It
loan
would shut you
because of
down
they would
100%.
shut me down.
4% origination. So let's say, let's say my kid's going to NYU, right?
Yep.
It's in your backyard, or
Yes, sir.
maybe it's a
It
little
is.
further than your backyard. Um,
You got a big
my
backyard,
kid's
Eric.
going to NYU. It's 80,000. Let's say I get 5,500 for federal loans, and let's say they do some type of financial award of, let's say I have to pay 40,000 at the end of the day.
Yep.
40,000. And let's say I just make just enough not to qualify for their financial aid, because NYU and other colleges, they do not have merit-based aid. It's just
Mhm.
financial-based aid. So you just make enough not to qualify for financial-based aid, and you're on the hook for 40,000, right?
And you love your kid.
And I love my
And their
kid.
and their friends are going to that school.
And their friends are going to that school, and their degrees at that school, everything about that school. They want to go overseas and study, and it's just man, I don't want to disappoint my kid.
Right.
So now, as a parent, I'm going to go and borrow 40,000 a year for 4 years. That's
$160.
$160,000, and the government's not going to.
They're not going to say, by the way, Eric, we understand your emotional state. However, you don't have a job or your job, you would if let me put it this
Well, I
way.
have a job because I'm making just enough to not
All right,
qualify for additional aid.
yeah, all right. So I said it wrong, but I'll say it this way. If you asked me for a car loan or a mortgage, I would say no. But the government, as a bank, I would say no. But the
Yeah.
government has this outlet for you to take that loan. So yes, and that's why at the very top I said I think the plus loan is really really tough loan. It's really not great. But there is an option. for parents and for parents to responsibly borrow, and that's in the private credit loan market. So the lender, the plus loan is the government. The lender for a private credit loan is somebody else, like a finance company, a bank, a credit union. States have programs. There's one in Louisiana. Go and take a look at those. So there's a whole array of these different programs that are out there. And actually, if you go to like, I think it's educationfinancecouncil.com or .org or whatever, this is an association of basically like state-based lenders. So you can check out on their website, like, who their members are. But in just about every state, I would like look around. If you Google like private credit student loans, you should find the program in your state. And then I would like be a consumer. I think we talked about this last time. One thing that to wring the emotion out and to try to help people make better decisions about financing college, think about it like a consumer. Like, what loan do I want? Like, what do I feel comfortable with? How much will they lend me? So generally, what happens with the private credit loans, there is no origination fee. They often offer, not often, they offer variable rate loans and fixed rate loans. By the way, my editorial comment is I don't like variable rate loans for college borrowing either. We can talk about that separately because the rates can go up and they can go up like very quickly, very fast. So I'm not a fan of that. I like fixed rate loans because I can budget that. I know what it's going to cost me, right? And I can refinance it down the road if it gets too expensive, right? The rates go down. So I like that. And also, they're going to credit test me. They're going to look at my FICO score. They're going to look at my income. They're going to look to my debt to income. They're going to do all the responsible ways that a lender will offer money to a client for a car or auto or an education, right? And so in
And
this case, though, let me just finish that
yeah,
point, Eric. The issue is there's no collateral, right? I can't come and take the car or the house if I don't pay, right? So those rates and the way that the education loan works for the parents, again, is very different than it works for the way it is for the student because I'm really just helping my kid, right? My direct benefit from their education is not a straight line, right? So it becomes a big thing. But the private credit market is pretty well evolved. It's about $10 billion a year, only about 10% of all of the borrowing done in the country for education loans, but it's a big market. And I don't want to seem like I endorse any product or another, but again, if you Google private credit student loans, there are ways then that we can. I'm sorry, I'm a fire chief in our department, and I just got a call that something was going on, but it's not in ours, so I'll just turn this off. Sorry
fire
for that.
chief.
Yeah, you didn't know that, did you?
I didn't know that.
Yeah, it's where our summer place is. So,
Okay, very cool.
anyway, the thing about the private credit loans is there are marketplaces for them. So your listeners are smart folks. They can go and Google private credit student loans and take a look at some of the offerings.
Okay, look, a couple follow-up questions. First, you know, some people might be thinking, well, that's messed up. They're gonna credit test me when the parent plus I can just go and not be credit tested. That's in your best interest as a borrower is to keep you out of trouble, right? It's to keep you out of trouble. So that's not a bad thing. Unlike the parent plus, where you said one of the things you don't like is you can't transfer to the student. These private loans can be transferred to the student.
So what happens is the student or the parent when you apply, they're basically both the student and the borrower and the parent are on the loan note as co-signers or co-borrowers. And then there's this great little thing called the co-borrower release or the co-signer release. And what that says is that after some period, so student goes to school. By the way, one of the things with these loans, the payments are due right away, right? So, you borrow that money and you're starting to pay right away. There's no, some of them have deferments and forbearances. You should really go and take a look at the specifics. But as a parent, I'm thinking probably going to start having to pay this pretty much right away. So I'm going to start the payments. But when I look down the road and my student gets out of school, they get a job, they're doing what they want to do, they're making money, and they get on their I'll say their credit legs, right? So they start to have a pretty good credit score. They have this opportunity now to have an opportunity to start repaying that loan themselves. The lender then will say, okay, I have a test. I'll do a credit test on the student, and once they're financially able, I'll release the cosigner. So the parents they're released, and now the student's fully responsible for all that debt.
Okay, so it will be based on the credit worthiness of the student,
Correct.
your ability to okay, which makes sense. I guess that's what makes it more of a responsible uh
Yeah.
loan, right?
Yeah,
Okay.
one thing about this though, and there is some research out fairly recently that like the cosigner release function, although it's a great marketing thing, not a lot of people use it because one thing they forget to do is actually go and apply for them to get the release. So if I'm a parent, I'm taking that out, and Sally's out working for 5 years and she's doing great. I might want to remember that she can
Yeah.
take responsibility for that debt.
Now, um, the terms, are they typically 10 years, 20 years? What's typical for those types of loans?
Yeah, so the answer to your question is yes. There's
Yes.
typically 10, but there are 5-year programs, there are 15-year programs. Again, it really depends on the lender, and that's why shopping around really makes some sense.
Okay. So that's an option for the parent.
Yep.
Is what are I'm assuming there's private options for students as well that you can walk us through.
So the options for students are really kind of limited, particularly for undergraduates. There are some programs out there that are for students that don't require a cosigner. There are one or two lenders out there, and again, your listeners and watchers can go and maybe just Google non-cosigned student loans or something like that. And there are a couple of lenders doing that based on program of study and some of the other I'll say aspirational attributes. Again, your point, engineers, they graduate, they get good jobs, right? So that might be an opportunity. The one thing I'll say about that, Erik, is that even for those programs, I don't know precisely what the approval rate is, but I would be surprised if it was much over 50%. It's probably closer to 30%.
Yeah.
Again, for the majors that are most likely to be higher income earners and that sort of thing. So there are programs out there for the students. Most times, though, this is where we get hazy between student and parent borrower. The student loan in the private market is technically a student loan because the student signed and the parent signed. So the parent, in effect, the student is the one who's originating the loan, but they need that co-signer to give them the credit oomph to get
Yeah.
that credit worthiness that you were talking about.
Yeah. Okay. Um, what else? What other options do we have? We seem to be exhausting all of our borrowing options. Yeah.
Yeah, the we're really sort of like at the end of the road now. Gifts from relatives and that sort of thing, which you know about. I don't focus on these, but maybe for some folks it makes sense. But there's some tax incentives, to deductions and credits and the like. But my thing is I can't feed my family with tax credits, right? So somehow I have to come up with that money and I might be reimbursed for it. But at the end of the day, I don't think of that as a way when I see 20,000 that I can go to the tax credit and, just authorize them to pay 2,500 or whatever it is.
Okay.
So I think that's really when it comes down to it that we talked about it. The financial aid award letter, private scholarships we mentioned. We talked about the loans, both the federal loans and the private loans. We talked about the tuition payment plans. We talked about gifts. We talked about part-time work potentially for a student. I think that is the list. And it's what I was saying at the beginning. There are arrows in the quiver, but there aren't all that many. So you
Yeah.
got to really be it. And the end of the day, if it's a $30,000 nut and you're just not going to get there, I think it's difficult, but better to have that conversation. Say we had to find a less expensive school, right?
Yeah.
I'm sorry.
That's exactly where I wanted to go and kind of put an emphasis on this idea of having a conversation. So hopefully your kid's a freshman or sophomore and you're listening to this and you still have time to have these conversations. If your kid's a senior, they're applying, it's hard. It's gonna be a little bit more soul crushing to tell them right now that they can't go to NYU because it's just too expensive. But when they're a sophomore, freshman, or maybe even a junior, having these conversations about college funding and about what you as a parent can afford um, is, I think, a very important part of the process.
Yeah, I agree. We did a webinar on the FAFSA the other night, and one of the guests was there working with families day in and day out, and they said, we actually recommend starting that conversation like in middle school when they're first thinking about college, and just on the high level, and say, oh, by the way, we have some college savings or we don't. Or,
Yeah.
let's look at schools. And one other thing, Eric, that there's a little sort of misconception out there I think it's really important, particularly for families like freshmen, sophomore, maybe even some juniors, to think that the in-school option is always going to be cheaper, right? I'm sorry, the in-state option
In-state.
is always going to be cheaper. And that just might not be right because some of the private schools have large endowments or they may have opportunities for merit-based aid that you talked about before. Everything we talked about through the federal is need-based aid, but there's also merit-based aid if, for whatever reason, like I think I mentioned to you on one of our previous chats, is that my daughter, who I love, but she's not a Rhodes Scholar, but she got like the same amount of aid offer from we live in New York, from a school in San Antonio, one in the desert in California, and one in the cornfields of Indiana, where she wound up going. And proportionally, it was the same amount of tuition. I think in that they were looking for geographical diversity. She was a really good student, but they wanted geographical diversity, right? And she was willing to go to the cornfields of Indiana, and she did nicely for as a result of that.
Yeah, so that's a good point that when you're applying, so if you're in the application process as as a parent with your student, apply for those reach colleges, but also apply for the realistic ones because
Mhm.
you never know what kind of offer you might get, right? And you
Yeah,
it's better to have tried and not gotten the offer you want than not have tried at all, but always have an option, a realistic option, and make sure that your student knows the what hangs in the balance. Like, yeah, you might get accepted to this college, but if we don't get the right aid, it's unrealistic. So let's
right.
have an option that you're equally excited about or close to equally excited
Mhm.
about. But it's having that communication. It's really important. And I know that, man, if one thing I've learned about being a financial planner is money conversations are really, really uncomfortable in general.
Yeah,
Spouses have a hard time talking about money. So then adding the dynamic of a student talking about money with your child about a very private thing that parents have a hard time talking about. I know it's hard,
it's
but
hard.
it is far better to start having that conversation early than to have it. We joked last episode about maybe whenever these conversations are being had, you should have a family therapist present. Uh, if you
Yeah.
don't start early enough, you're probably going to need a family therapist present.
Yeah, no, I think that's right. And we started with this. It's like trying to wring the emotion out, and the earlier you do it in the process, the easier it becomes toward the end game. But again, there are a ton of great schools out there, and going to expensive brand name school X doesn't guarantee a great job. And I use this example fairly frequently. When we were in Boston, there's a great college on the North Shore, nursing school that has like 100% placement rate of their graduates into the best schools in Boston. Uh, Nobody knows this school, but it's a great nursing program. I met a woman whose daughter was going to big brand name school in the Midwest, a great football program. It's really like, oh, wow, everybody wants to go there. And she was borrowing $40,000 a year for her kid to go. And the kid's going to is going to be lucky to get one of those jobs in the Boston hospital,
Yeah.
right? And so again, it's hard, it's emotional, no question about it. But it's just the reality, and it's also where exactly where the first interjection when I interrupted you rudely is say, and you love your child. So this
Yeah.
is that value play all the time. It's like all the stuff happened, and now this is my last chance to like really show them,
Yeah.
and I'm gonna go borrow in my 401k or I'm gonna take
Yeah.
$160,000 of plus loans, and I'll figure it out later. And some people just can't figure it out later because they put themselves in too big of a hole.
A business mentor of mine would always say, when you put emotion between a decision, especially a financial decision. So there's me and there's a financial decision I need to make, and I put emotion between it. It's often a bad decision. Now, it doesn't mean that these are not emotional decisions,
Right.
right? But what it means is I have to be able to identify that emotion, put it to a side, make a financial decision, and then come back and reevaluate the emotions around it. And yeah, It's tough. It's tough. Um, John, give us any, I mean, this entire podcast is peppered with wisdom and kind of your editorial advice and opinions, which I think is good. Sum it up for us. What's the one thing I need to know? The one piece, the silver bullet.
The silver bullet, Eric, it's gonna be okay. I tell people take a breath. And like, I don't. There are lots of things that happen, but folks who are listening to this and watching, or they're reasonable. They know sort of what the parameters are. But I always say one thing: this is the time in life to be realistic, not optimistic and not pessimistic about like what it is, right? You know how much you saved or didn't save, and that's not a value judgment. If you didn't save anything, you didn't save anything. It's too late to go back and worry about that, right? So just try to be realistic about where you are and what's going to happen, and realism financially, as well as emotionally, like what's going to happen. And so I think if you can do that and really think solidly and step back a little bit, things are going to be okay. And I firmly believe that.
Awesome. John, I guess we'll do this again next year, huh?
Hey, look, hey, Eric,
Next,
maybe when those financial aid award letters come out and people are all confused about, like, okay, what does
yeah,
this mean? We can sort of sort through that. But anyway, great to talk to you. Appreciate being a guest on your show. Thank you.
appreciate it. Take care.